Good morning, good afternoon, or good evening, depending where you are on the planet, and welcome to the Monday, the 10th of June, Bull versus Bear webinar. Steve Miley here on the Call for Trade Day. Welcome, everyone. Going to go for our usual run through in here, but with a slight twist in here for a Monday where we look at the shape of the week, the bigger picture outlook for the week to give us an idea of where the pockets of either volatility or lack of volatility might come throughout the week, so you can adjust maybe your trading approach, your trading strategy, your targets, your stop losses, on the expectation of different volatility measures as we go through the week. So beneath where you are right now, if you're watching this live or on the catch up, if not if you're on YouTube, obviously, but if you're in the members area at Trade Day, you will be able to go below where you are and see both the macro matters, which is the more in-depth recap and outlook for the week. So that goes through everything that we've had and what we've got coming up. And then there's also the weekly recap and outlook, which is the shortened summary version here. So I'm going to use this as the base to start off in here today. So basically, we had a positive week. Last week with stocks up, making new highs particularly on Wednesday. The video leading the way higher on Wednesday, and then after there was growing optimism, we saw some of the data was actually quite negative data for much of last week. So slightly negative, slowing economy. Then that implies Fed more likely to cut and be more dovish, and then that is positive for stocks. So counterintuitively, slightly weaker data is positive, and so we saw markets moving higher in prices. Bonds were moving to lower yields as there was a growing anticipation of potentially rate cuts. And then on Friday, we get the US jobs data, and it's really interesting the differing market reactions we saw. So we saw this aggressive move with bond markets moving to lower yields, higher prices, lower yields throughout the week, and then recoiling to higher yields on Friday because the very, 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 very strong US jobs data that we had in here, implying that maybe the Fed won't be in play as quick as we expect, and maybe the Fed won't be cutting as aggressively as we expect. So going forward potentially into Q4, we're looking at now for that to maybe September, maybe late Q3. So we had this kind of counterintuitive moves at the moment. That strong data is seen as negative for markets, or when I say markets, sorry, I mean the US stock indices, and then vice versa, weak data positive. So weak data through the week saw markets moving higher, more anticipation of rate cuts, and then the opposite of that on Friday. And particularly, even though the equity markets didn't really have a big sell-off, they did dip lower. We'll take a look at what happened to bonds. There was a really aggressive move on bonds in here. So that's kind of covering the US labour market's unexpectedly strong jobs creation, reduced the likelihood of the Fed cutting rates as early as September. But we did get rate cuts last week, but from the ECB and the Bank of Canada. More interestingly, the ECB in here kind of not indicating definitely one and done, but it was a very hawkish cut. What does that mean? Well, their cut rate, which is dovish, but the tone was kind of, well, that might be it. We're going to wait and see now. So not implying that there were more rate cuts to come. And so going into this week, the key things we're going to be looking at both on both Wednesday. Okay, so we get double trouble Wednesday, both the US CPI data followed by the Fed decision. Now, obviously, we're not expecting anything from the Fed decision, but we do get the dot plot chart. I'm pretty sure we get the dot plot chart. I'll double check that, but I'm pretty sure we get the dot plot chart on Wednesday. So it'd be interesting to see what the Fed are now looking for going into the end of the year. We'll double check on the dot plot chart. On the data side, clearly the US CPI data is the important piece of data. On the interest rate decision is the Fed on Wednesday. We do get Bank of Japan also this week on Friday. Other data to note, well, actually this Japanese data is actually tomorrow, I think. No, it's today. No, it was this morning. Sorry. Japanese GDP. Looking forward to tomorrow. UK employment report. Not much from the US at all for the first couple of days this week. So likely, given that we've got all of this happening on Wednesday, and seeing as we have nothing of real note, I think it's going to be consolidation on Monday, Tuesday. So not expecting too much. Keep an eye on the bond markets, going to be critical. Bonds are continuing to go to higher yields. Stocks are very, very resilient at the moment. Stocks are holding in really well, considering the big move. And we'll look at it shortly in here. Big move to higher yields on Friday. Stocks hang in there. So if we continue to see higher yields, I don't think we're going to see a big sell-off in stocks, because we didn't really see a big sell-off in stocks after the higher yield moves. If we get a reversal in yields, if they kind of consolidate that down towards lower yields, you could see stocks moving higher on that. I think that could be the way that this plays out Monday through Tuesday. Then Wednesday, it's all going to be about obviously US CPI and the Fed, but we also get Chinese CPI, German CPI, and UK GDP. So it's a busy day globally Friday as well. Then things calm down again. Australian employment, US PPI after the CPI and after the Fed is unlikely to have a big impact on markets. And then we get the Bank of Japan, unlikely to be that important. And then Michigan consumer sentiment to end the week in here. So stocks were obviously higher, hit records on Wednesday and nudged higher on Friday. US and European bonds initially lower yields and then a big recoil to higher yields on Friday. US dollar index dipped slightly through the week, but then went surging higher on Friday as of those higher yield moves in the US. Gold futures plunged Friday with this inverse relation to the US dollar. So dollar was up Friday, gold plunging lower, and oil futures initially selling off and then rebounding. So that's kind of what we saw yesterday. If we look into today, you can see there's hardly anything of note. We had some slight bits out of Europe, nothing really of note yesterday, and tomorrow's light as well. We've got some UK data in here, as we've already mentioned, but very little in here. So it's all I think it's going to be very quiet Monday, Tuesday. And I think we'll only see an upside bias in stocks if we get yields moving back lower. So we'll come to that shortly. The big over the weekend news in here is Europe's far right surge. This has been expected anyway. There's been a groundswell from the far right in Europe in here. So we had the European parliamentary elections. So this is the parliamentary elections for the whole of Europe. Because of the jump in support for the far right across Europe, and particularly in France, Macron in France has called a snap election in here, okay, which could cause some political chaos in here. German Chancellor Social Media also saw a crushing defeat, again, amid gains for conservatives and far-right parties. So the middle ground is losing out in here. We're seeing the far-right doing very well in Germany, in Austria, in the Netherlands, in France. This was kind of very much expected from the polls that we had in here, and it is kind of a concern on the bigger picture. And today it's seen the instability that this has kind of created, both the snap election in France and the increase in support for the right wing parties in here has meant that we've seen all of that uncertainty. Is obviously uncertain. Stocks don't like markets. Risky assets don't like uncertainty. Stocks are risky assets. So European equities in here significantly lower in here, and bonds in here, French bonds particularly selling off, going to higher yields. Okay, because of those concerns. Though Apple was an early pioneer, and that seems to be a laggard, especially since ChatGPT. But now having a push in here expected for its developers conference to see if it can become a major player. And then the rest of this, nothing really that significant. New York Fed losing streak. The Federal Reserve Bank of New York seen many senior level departures. Nothing's that's really impact up. Cost of owning a home in the US increased 26% to 2020, and then looking ahead to this week. So the big real news story over the weekend in here has been the surge in support for the far right parties in many European nations, in the European parliamentary elections, and the snap election in France. And I've got a load of articles on this. So French market slide as nation plunged into political turmoil. French banks lead stock market plunge. Analysts see risk to bond spreads in the euro going into the French election. Fallout from the European election hits euro bonds. Currency weakens. Macron calls election in here. And again, look, the headline here, morning bid, Europe jolted by Macron's snap election call. More from Reuters, the Europe stock 600, that's the top 600 in the Eurozone in here, falls as French stock roiled by political uncertainty. So this is grabbing all the headlines. And surprising, US is not lower really on the back of this. I know it's Europe-centric, but nevertheless, this is the whole of Europe. We know this is affected. And obviously, France is a significant part of Europe. Europe jolted by Macron's snap election call. Rates and politics cast a shadow over markets in European markets this morning, and futures lower in here on rate cut jitters ahead of the inflation and Fed meeting, but also lower in here because of European stocks being pulled lower. Let's look at the aftermath of Friday's non-farm payroll report in here, and you can see this is the September meeting. This is the historical. So this is the chances of the rate cut, and I've narrowed it down to the 500 to 525. That's the one rate cut. Okay, that's one rate cut by September, and you can see all last week we were saying that there were increased chances of a rate cut, and then boom, Friday it reverses back lower. That's the September chart, and if you look at the December chart, the year end, this is for two rate cuts. Now you can see growing chances through the beginning. Going into early June in here, and then on Friday falling back lower. And if I switch this out for the one rate cut, you can see in here a leap in chances for only one rate cut, because there's less chance of there being two rate cuts now by the end of the year. So a leap in expectations of one rate cut, and a falling in here for the chances of two rate cuts by year end. That was on the back of the employment report. Asian stocks in here, the Nikkei, Japanese Nikkei, is up about 1% in here, with the Hang Seng down 0.6. European exchanges obviously lower. The CAC, the French CAC, getting the most hit in here, 1.8% down in here this morning on the back of that snap election. But other European bourses also lower. The DAX, the German DAX, down 0.6, and the UK FTSE down 0.3 in here this morning. And then that slightly dragging down exchanges in here. Not huge in here. We're only down about 1/10 on the S&P. So US are hanging in particularly well, particularly after the higher yield moves, and we'll look at those again in here going into today. So look, there's that big higher yield move that we saw on Friday. This is the US 10-year note, significantly high, taking back about half of what we kind of saw the sell-off in here. Sorry, not the sell-off, the rally in bonds. That's bonds rallying to lower yields. They go up in price, down in yield. So we saw the rally in bonds in here since the beginning of the month, and mostly last week. And then we saw a big reversal of that on Friday, and look, gapping up and going higher yields in here already this morning. And if we look at that on the US Treasury chart in here, so on the market charts reports, what we'll see is here the US 30-year, all of the markets significantly down on Friday, but we're hanging on to a bullish bias here. But if you look at we've switched to more negative on the 10-year, the 5-year, and the 2-year. Bearish, more significant bearish at the short end, because obviously that's where the potential, the short end more sensitive to interest rate moves in here, and central banks rather than the economy. And obviously that weakness that we saw, the strength in the economy, meaning that because the jobs report was so good, a strong labour market, then more prone to hit the short end, because there's less likely to be rate cuts and deeper rate cuts, because the economy, the labour market is remaining strong. And surprisingly, given the significance of these moves, the 2-year, the 5-year, the 10-year, we've gone bearish on these markets. There is a correlation, and it's surprising that the Nasdaq pretty much just hung in there, right? We just hung in there on Friday. It did dip lower, but didn't really give up much ground at all. You would have expected more from the Nasdaq, being growth stocks. And then similarly in the S&P, just high level consolidation, really. Go and take a look at the charts. Yes, it was like a negative day. We look at the Nasdaq first of all. Yeah, it's a bearish outside day. It was outside Thursday's session. But, in light of what we did on Wednesday, it's not much of a dip lower in here, and we're hanging in there today. So this is particularly bullish given what we're seeing here. This big higher yield move on the 10-year on Friday, and 5s, 10s, 5s, 2s. We looked at the charts there, and then gapping to still higher yields this morning. The market's hanging in pretty well. The Nasdaq hanging in pretty well, and the S&P in here similarly hanging in pretty well. And I think any kind of respite, any kind of reversal back on it, if we can move back into lower yield territory, it could set up stocks for more upside. So we're remaining bullish on stocks as we go into today. You need to keep an eye on Europe if there's any developments. Probably won't be any further political developments, given that the snap election has been called in France. But keep an eye on those European exchanges. They could pull the US down, but the US is kind of seems to be doing its own thing, ignoring the European concerns around the snap election and concerns around the rise of the right-wing parties in Europe. And then obviously it's going to be a relatively, well, not obviously, but my call is it's going to be a relatively quiet start to the week. Monday, Tuesday, we could see fairly narrow ranges, maybe looking like we saw back here on, if I go to, look at Thursday's ranges after that big push higher on Wednesday, fairly narrow range. I wouldn't be surprised to see ranges like this in here, and similar on that's the S&P, and here's the Nasdaq. Similar ranges to this that we saw on Thursday. Maybe an inside day today. My bias slightly to the upside, because I think we are holding in very well considering what's happened on yields and considering what's happened in Europe in here. There's every reason that we could be lower in here, and the market's not low. If a market doesn't go down on bad news or news it should go down, and it should be down, should have been down a lot more after the yield moves on Friday and the continuing yield move this morning. This market should have been down on the European news that we've had over the weekend on Sunday, breaking through into Monday, and it's not down. So a market that can shrug off bad news and hold in, goes sideways, says to me that any kind of respite on that bad news opens up to the upside. So I'm bullish, but not uber bullish in here. Just thinking we could push back higher, back into Friday's ranges going into today. And similar story, probably a bit early to call yet. Let's see what happens in the next 24 hours. But similar story expected maybe for Tuesday as well, ahead of what is double trouble on Wednesday when we get both US CPI and the Fed decision. A quick look in here on as you know, I'm going to leave it. We can look at whether the dot plot chart. I'm pretty sure it is the dot plot chart coming up on which give us, obviously we're not expecting any moves from the Fed, but it's interesting to see. But I'm pretty sure it's every other meeting. I'm sure we didn't have it last meeting, so we'll be checking out the dot plot chart as well on Wednesday. But we'll look at that before we get to Wednesday. All right, guys, I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another Bull versus Bear webinar on Tuesday. Bye.